In this video, I'm going to show you how to read financial statements and explain exactly what the different line items mean. So you can look at any company, and within a few minutes of looking at the trends, you can tell if it's a good company or bad company. And if you've been looking at crypto, you really want to watch this through, because I'm going to explain to you the numbers with this example of why you should stay away from crypto miners, because they're really destroying shareholder capital. I'm Henry Chen. I teach individual investors how to get higher returns from picking stocks with the fundamental process. You can subscribe below to learn more. And if you want to learn more about how to use the fundamental framework, just check out the link below. This is a Koifin data terminal. I've pulled up Riot platforms. It's a crypto miner. This crypto miner will buy miners. So that's computer equipment to mine Bitcoin. They're going to mine the Bitcoin and then they'll sell the Bitcoin. Basic business model of how they're going to make money. Let's walk through the numbers and I'm going to show you exactly what they mean and why this company is actually very terrible for shareholders. Let's start off with the income statement line items here. Starting with revenues. Revenues basically means the sales of the business. And usually what we're looking for is any growth, because that represents the expansion of the business. And it's usually a function of two things. So it's a function of the volume, so the number of products being sold, and the price, so the price of that product. For Riot, this crypto miner, is the number of Bitcoins multiplied by the price of the Bitcoin. So that's just something to keep back in your mind when you're looking at revenues. The first thing I want to look at is the overall trend in revenues. Obviously, it's going up. It's gone up from 300,000 to 280 million. That's pretty good. What I also like to do is look at the year-over-year change, so the growth rate, because then the growth rate can tell you what is going on in the business and whether or not it's a stable type of business. This one swings a lot. You can see that there's huge changes in growth rate. There's also decline in 2019, huge jumps in 2020 and 2021. If we remember what prices are like for Bitcoin, there was a huge jump in 2018 and 2021. But what that tells us immediately is that prices of Bitcoin are very influential to this company's business. The price will go up, so that also increases their revenues, and most likely is as the price is going up, they're also buying a bunch of mining equipment so they can sell more Bitcoin, and that's also leads to an increase in revenues. Now, revenues is not the only thing for a business. There's obviously a bunch of costs, right? This is where gross profit comes in. Gross profit represents if you take the sales and then you minus the cost of production or the cost of delivery. What that represents is its unit economics. It's essentially the profitability of that product or service before the expenses of running the business. So the sales would be the revenues related to the sale of Bitcoin. The cost would be the cost of the miner. So that would be things like electricity or headcount, as an example. The gross margin represents how much profit is being made for each sale. You can see that it was quite high in 2017, 2018. What that means is if it's 90% gross margin, that means 90% of those sales were directly turned into gross profit. But that has gone down and now it's about 10%. So why is that swing? Usually if a business has an increase in price, it doesn't really change the cost of the good itself. So for Riot, when crypto prices went up in 2020 and 2021, the cost probably didn't go up so much, and that's why gross margins rose. When crypto prices came down, it seems like their costs had started to go up, and that's why gross margins had started to decline. So this represents the core profit of the business, because if the product itself can't make any money, it doesn't matter what the rest of the business is doing. It's not going to make money. So the next level is we want to look at income. We take our gross profit, so the profit from selling that Bitcoin, and we want to remove other expenses. That's where we can get something like EBITDA. And what that specifically is, it's earnings before interest, taxes, depreciation, and amortization. Think of this as a measure of the income of the business. Now, unfortunately, Riot has never generated a profit. Even on an EBITDA basis, it's been negative. It looks like it's even been getting worse, losing $150 million in 2022, getting slightly less worse in 2023. But the point is that this business is not making any money. We can start to look into the income statement if we want to figure out why that is. Where are all these costs? If we look into the operating income and expenses, I can see that there's basically two expenses. One is SG&A, so that represents the payrolls for the business. Second thing is depreciation and amortization. So that represents if they're buying equipment, depreciation and amortization represents the wear and tear of the equipment. Because if you're buying a mining equipment, it's not going to last you forever, right? It's going to have a specific timeline that it's going to be useful. So depreciation and amortization is a way to account for that cost of it eventually becoming useless. So they have a really high cost of both payroll. It means they're paying out a bunch of money to their employees. And they also have a really high cost of depreciation. Amortization means like their equipment that they buy really depreciates and it falls in value really fast. And that's why they're having a very difficult time turning a profit. Now, why is this important for us as a shareholder? Let's go back to our highlights section. If a business is selling something and then they get their gross profit and then they pay out their operating expenses, what should happen is they should have some sort of net income. So net income represents the profit after paying all the expenses. Now, from a shareholder perspective, if I own this business or if you own this business, we own this stock, the net income represents the earnings that is available to us. Key point here, if a company is not making any profit in net income, it technically isn't making any money for its shareholders. There are no earnings generated for its shareholders. And that's why net income or earnings are kind of used simultaneously. Earnings is so important because earnings represents the profits that the business has made after paying out all expenses that technically belongs to the owner of the business. And that's why if there is no positive net income, there is no positive net earnings per share, that means that there's no earnings being created. Now let's think about this from a cash perspective. Here we're in the cash flow statement. Now I'm going to explain to you one quick thing. It's that some expenses are not cash expenses. So remember, depreciation and amortization, it represents the wear and tear of an equipment. That actually isn't a cash expense, right? It just means your equipment has worn down. That's why the first thing that the cash flow statement does is it removes depreciation and amortization so you can start to see the actual cash that the business is generating. So if I move down here, the cash from operations, this number over here, that represents the cash that is being generated by its operations. It represents actual cash generated. You can see that they were negative for some time, but not as bad as earnings. So it does mean that the business was almost about to start generating some positive cash, and it actually turned positive last year. That means the business is starting to generate cash. Now, the thing is, and this is an important point, this business does need to keep investing, meaning it does need to keep buying new miners in order to keep growing its business, right? Because if the miners are starting to decline in value, they need to be replaced. Or if the business wants to grow and sell even more Bitcoin, it needs to buy more miners. So what that comes out of is something called capital expenditure. Capital expenditure represents investments into the business. That's in the cash from investing section. This is why capital expenditures are so high, because they have to replace the equipment, and when they want to grow, they have to buy even more miners. And that's why the capital expenditure is 340 million, 420 million. It's like quite a lot of capital expenditure. And it indicates that they're investing a lot, they're buying a lot of different miners. Now, the key calculation here from an investment perspective is something called free cash flow. So free cash flow is we take the cash from the operations, so the cash that is generated from the business operations, and then we minus the capital expenditure. So we remove the investments, and then that gives us free cash flow, which represents the cash that is available to shareholders. They're not calculating here, but say if we just calculate 33 million minus 420 million, that's about a negative 400 million in free cash flow. That means that there is no cash actually available for shareholders. Free cash flow is important because if a company can generate positive free cash flow, it means that you have cash that literally is available that you can either pay out in dividends or you can repurchase stock. And that's why when there is no free cash flow, there is no value for an owner of a business. Now, if free cash flow is negative, right, where is the cash coming from? It also means that the company is using up cash. So now let's move on to the balance sheet. So we start off with the cash and cash equivalent because that just represents the cash reserves that the business has. So if the business is not generating any positive free cash flow, it has negative free cash flow, that should mean the cash balance should go down. And you can see that does seem to be the case in 2022, if you can kind of see behind my thing. So 2022, the cash balance did go down, but it did go up. Where is that money coming from? Well, if we want to look at where money is coming from, we want to start to think about, is it coming from either liabilities? So down here, liabilities usually represents things like debt. If we look over here in the long-term debt section, they do have no debt. So the second place to get money is from the equity side, which is selling shares. So we go into the equity section, and that's where the common stock or additional paid capital is. That represents the cash that is raised from selling shares. You can see that's where they're getting all that cash. They've effectively sold $2.6 billion in stock last year. I don't know who's buying it. They've sold their share, and that's where they're getting all that money. And so the balance sheet, you can start to see where all that money is going. They've sold all this stock. They raised all this money, but some of it's going into cash. That's why they have $600 million in cash here. But where is everything else going? Well, if we look into the asset side, you can see the net property and equipment, right? So that is the line that is going up. That's where all the cash is going. When we talk about capital expenditures before, so the investments, that goes directly into the property and equipment line. This represents the amount of money that they've spent on miners. This represents all the miners that they have. So that's gone up from 10 million to 700 million. So what this means is that business has sold a bunch of stock and now it has bought a ton of miners, and that's where it sits on its balance sheet. Let's think about this from the balance sheet perspective. They raised a bunch of stock. They raised all this money from selling shares, so close to 2 billion in 2022, and then they've put that all into the assets. It looks like they're just buying a bunch of mining equipment, right? So they've taken that money, they bought a bunch of mining equipment, but then what do we get as an investor? So now let's think about it as an investor. We've given them a bunch of money, we bought their stock. What do we want as an investor? We want a return. They should be making some sort of money with the capital that we give them. Let's look at the highlights again. So from a gross profit perspective, you're getting lower and lower profits because they're just not making money from selling Bitcoin relative to the cost of those miners. After paying out all their employees and after accounting for the depreciation of this equipment, what do we get from net income? It's also negative. So we're not getting any kind of earnings as an investor here. And so where is our return on investment? There is no return on investment. And also, if we look at it from an earnings per share perspective, we also want to normalize based off the fact that they've sold so many shares. What is the earnings per share? That's also negative. So what is our return on investment? It's basically zero. There is no return on investment. The other thing is that we want to start to think about the financial health of the business, right? We look at the cash flow. They're generating about 30 million in cash from operations. We take away the capital expenditures. So it's negative $400 million every year. If they keep that up, remember how much cash do they have on their balance sheet? They have about 600 million in cash. If they're burning 400 million in free cash flow, what's that going to do to the cash balance? In 2 years, you're going to blow past that 600 million. So then there's this other risk here is that they're spending all this money on equipment, on their payroll, and it's just going to burn through the cash. And then what happens if a business has no cash? Well, it goes bankrupt. And what that means is that the business files for bankruptcy so that it can start to sell off its assets and pay off any remaining investors that are still holding the stock. And that basically wipes out any equity. So now if we think about this from an investment perspective, there's only one way that this business can really work, is if crypto prices increase enough so that its sales grow enough that it can cover its gross costs so that its gross margins can finally increase and it can cover all the expenses that they're doing from their payroll, and it can also cover the wear and tear of the equipment and also cover the continued investments into these miners. And so you could start to do the math over here. You really need a pretty high increase in crypto prices for this company to make any money. So from my perspective, like what this means is this company is just destroying shareholder capital. If you buy this company, you're not getting any return. The only way you get a return from this business is if crypto prices go up. And then from my perspective, why don't you just go buy crypto then? It's a lot easier than buying this kind of trashy company that's just destroying shareholder capital. So I hope that was useful because the key benefit of learning how to read financial statements is you can start to screen companies really, really fast. You can read through the financial statements and really weed out the bad ones so you can focus on the quality ones. There's one person in our program, we taught him these concepts. He blocked out some time to look at stocks. He was able to find a great company that returned 50% to him in less than 6 months just because he started to understand how to read financial statement. He picked out a really great quality company. So if you do want to learn more, I do have a financial cheat sheet that has a lot more explanations. It's in the free training. All you have to do is sign up because I know there's a lot when it comes to financials. What we want to do is really want to help you pick out good companies by teaching you this kind of stuff. And so if you like this, subscribe, like, and leave a comment because I love feedback and I would love to hear from you.